Hi all, and welcome to our webinar today on surprise forecasts and predicting earnings surprises with Refinitiv Workspace. We're delighted to have you with us, be it your morning, afternoon, or evening, wherever you are right now across the globe. We have a great mix of existing clients as well as first-time guests registered, and we thank you all for joining. My name is Peter Smith, and I'll be introducing the session and our speakers, two of our very own from Refinitiv, Tim Gaumer, Director of Fundamental Research, and Tajinder Dhillon, Senior Research Analyst, as well as helping moderate questions that you have in the Q&A portion of the webinar. I'm a Global Director focused on business development within the Research and Portfolio Management segment here at Refinitiv, of course, a London Stock Exchange Group company. Very quick housekeeping note. You can manipulate the windows and enlarge the slides and access the resources folder on the side panel. Also remember, we definitely want your questions, so please enter them in the Q&A section as we go, or at the end, and we will try to get as many as we can. You'll see material today in the presentation, as well as in the resources section, that showcase both our StarMine Alpha Analytics, as well as our Refinitiv Workspace for analysts and portfolio managers, which is our workflow solution offering, which is most relevant for this audience. We launched this modernized and powerful solution in April of last year and have seen both new and existing customers take advantage of this new offering, which clients tell us surfaces our breadth and depth of content and analytics more efficiently and effectively with its streamlined navigation and AI-powered smart search. So in this webinar, we'll aim to cover the following in the presentation: what data we rely on when we're making predictions, the value of anticipating which companies will beat or miss earnings expectations upon reporting, tools for making your fundamental research more efficient and effective, and lastly, but certainly not least, where you can find and apply the StarMine Smart Estimates to your investment process within Refinitiv Workspace. So we're going to run through two very quick polling questions to get a better understanding of the audience and the application of quantitative analysis in the investment process. So let's launch poll number 1, please. Perfect. So in this poll, simply put, what role do you identify most closely with? Is it a buy-side analyst, a sell-side analyst role, a portfolio manager, or another? Could be CIO, any other of the roles, credit analyst, etc. So we'll give the group maybe just a few seconds here to get in some answers and responses, and then we'll show the results momentarily. So we'll give the audience just another 10 seconds or so. And it looks like we have a good mix, some buy-side analysts, sell-side analysts, portfolio managers, and a swath of other, which is great. So thank you so much for participating in the poll. We have one more poll question for you. And this one here is really just about, to what extent does quantitative research play a role in your investment process? So we'll give the audience all of you just a few seconds to add some answers there. And cool, looks like we have some folks who love a good bit of quantitative research, which is great. We got to a great extent and some degree. That's fantastic. Thank you so much for that. So it is now my pleasure to introduce our speakers. First, I'd like to introduce Tim Gaumer, Director of Fundamental Research and Proprietary Research at Refinitiv. Tim is based in San Francisco and runs a global team of research analysts and contributes greatly to leading the strategic direction and application of our StarMine alpha models and analytics content within our products and solutions. A frequent speaker and contributor to the CFA Society and many other industry events and conferences, I'm thrilled to have Tim on the call today. I'd also like to introduce Tajinder Dhillon, who who is a senior research analyst based in London with our fundamental research team. You can see some of his insightful articles and posts on our Lipper Alpha Insights website, located at lipperalpha.refinitiv.com, or by using the keyword alpha within Icon or Workspace. Articles he's posted in the last few weeks include a spotlight on the oil markets, the Stock 600 earnings outlook, as well as a number of earnings dashboards and scorecards. So with those introductions, I'd like to welcome Tim and TJ. And Tim, I'll hand it over to you.
Thank you, Peter. Yeah, I'm delighted that there's so many people interested in quantitative analytics, because that's what I've focused my career on for some time now. Beginning with StarMine. So StarMine was one of the original fintechs. Actually, so long ago, the term fintech hadn't even been coined yet. But we've been building predictive analytics and alpha ranking models in a very transparent, clear box, not black box way, for many, many years now. And we continue that tradition as part of Refinitiv and LSEG with a much broader set of content and data. So we're taking full advantage of that, much to our quantitative research team's delight, and still based here in San Francisco. Our SmartEstimate is now celebrating its 20-year anniversary. Actually, it just turned 21. A recent study showed that it's still as accurate as it has been since its inception. In fact, we have a white paper, a research note on that. If you'd like to learn more, raise your hand at the end. So last year, our results turned out pretty well. The SmartEstimate, just right out of the box, is predictive of the direction of earnings surprises about 70% of the time, with a very light human overlay, which I'll show you how we apply, or TJ will actually. He creates these predictions. We got 8 out of 10. We picked 5 to beat, 5 to miss. We got 8 out of 10 correct for Europe last year. Same in Asia. Even better in Latin America, 90% accurate. And in our last quarterly prediction for North America, we got 90%, 9 out of 10, directionally correct. We'll show you how to do this. You can do it on your own. Even better for regions or countries where we don't publish forecasts. So we show you the basis on which our earnings season forecast is created, how to build your own, and where to find ours. So StarMine is probably best known for and got our start by rating and ranking sell-side analysts, with the recognition that not every sell-side analyst is created equal. Some are good stock pickers, but not very accurate with earnings estimates. Others are the opposite. So what we're measuring for the StarMine SmartEstimate is looking at sell-side forecast accuracy. Looking at their earnings estimates and other estimates, anything they publish, revenues, cash flows, EBITDA, a number of things. We look at their accuracy over 6 different look-back periods, 4 fiscal quarters, and the last 2 years. We rate them 1 to 5 stars. It's a normal distribution. Only 10% of all analysts globally get to be our top-rated 5-star analysts. To do that, they have to do 3 things well. They have to be different than consensus. They have to be more accurate than their peers. And because we measure their accuracy every day throughout these 6 different periods, they have to be early. So different, early, and ultimately more accurate. So this graph here depicts the analyst in blue. The consensus, or the IBIS mean, is shown in gold. And the company's actual reporting results are shown in the black vertical bar. What makes the SmartEstimate useful is this skill seems to be persistent. So analysts have been more accurate in the past, are more likely than not to be more accurate than their peers going forward. We can use that knowledge about which analysts tend to be consistently more accurate to build a more accurate version of the consensus estimate. That's what we call the SmartEstimate. So the smart estimate places more weight on the more accurate analyst than the more recent estimates. So you can see how this in the little panel here, the screenshot. Normally we blurred it out just to protect, intellectual property. The contributor would show the name of the brokerage firm that the analyst represents. We'd actually show the analyst name and their contact information. We show their 1 to 5 star rating. Then we show their estimates. Click through to a PDF and actually see their report, the date that they published their recent estimate. And notice there's one there that's highlighted in red. That's called a bold estimate. So a bold estimate flags unusual activity from the most accurate analysts. So here you see this analyst estimate is 5 star. If it happens within the last 30 days, if it's significantly different than consensus, both in terms of percentage and currency terms, we flag that as a bold estimate. So this analyst is well below consensus. So this is a negative bold estimate from a very accurate analyst. If the analyst had been above consensus, we'd put a green box around it. So it represents unusual behavior. Usually analysts move incrementally. They'll raise or lower their estimate a bit, kind of look for confirmation if their peers have done the same, and then maybe move again. This analyst has really stuck his or her neck out. So that's why we call it a bold estimate. It's bold behavior. In the far right, we show the weight that we place on the analyst based on their accuracy, their star rating, and the age of the estimate. So you can see that the second analyst here is getting about 24% weight, and so is this 5-star rated analyst who's more accurate, but the estimate's a little bit older. So the way we determine what is a fresh or stale estimate is based on a revisions cluster methodology. So when roughly a third of analysts, as in this case, move in the same direction within a few days of each other, we'd say, well, they're reacting to some significant new development. These are analysts who have followed the company, usually for years. They're experts on it. If they all agree that there's something new that's caused them to rethink and publish new estimates, we flag that as representing new information. We include it in the smart estimate. Analysts who may be lagging a bit behind, we mark X cluster, excluded from the earnings revision cluster. When they update, they'll move into the smart estimate as well. And then you see the one at the bottom with the white arrow, X age. This estimate is excluded simply on the basis of that it's very old. So any estimate that's older than 120 days, we exclude just because of age and flag it as X age. So of course the smart estimate is most interesting when it's significantly different than consensus. We measure the percentage difference between the smart estimate and the mean, and we call that the predicted surprise percent. So here you see in this example, it's fairly extreme. The smart estimate is 18% below consensus, meaning there's a lot of stale data, perhaps in consensus. You can see the history on the bottom panel. You can see that hasn't been the case for long. The smart estimate is shown in gold. The consensus or the IBIS mean is in purple. And it was only recently where the smart estimate deviated sharply, moving below the consensus. That means it's predictive of the direction of future revisions as those X cluster sort of slower analysts catch up and move in the same direction for probably much the same reason as the leading analysts. So it means that consensus estimate is likely to move down, or if the company reports before they catch up, we're at least 70% likely to see a earnings surprise in the direction of the predicted surprise. So in this case, we'd expect this company to miss when they next report. We do much the same for economist polls. So Reuters goes out and periodically polls at least hundreds of contributors. about their outlook for all number of macroeconomic things, currency rates, GDP growth, inflation, now on everyone's mind. So they have a number of different indicators in over 60 countries, about 30 FX rates, 1,000 economic indicators, and we show this much like we do the SmartEstimate. Compared to the consensus, we find economists, despite the jokes people make about the dismal profession, they're actually more persistent in their forecast in being accurate or not than sell-side analysts. So we can rely on this to come up with a more accurate outlook for a number of different macroeconomic indicators. So if you take a top-down view at all in your investment process, this can be a very useful tool. We look at it over a 1-month forecast, 3 months, 6 months, or 12 months period. The key difference between this and our SmartEstimate is there's no revision cluster. There's no concept of stale or fresh estimates because Reuters goes out, polls everyone at the same time. They expect the responses within a very short window, hours, and then they publish these results. So all of these results you'll see are fresh. So dive into a little bit about some of our analytics and quant models here. We built a lot of stuff. Now it's part of Refinitiv. We have free run as a quant research team over a huge amount of data and content. We got our start and continue to build on classic quant factors. These tend to be sort of academic models in their origins, which we confirm and enhance. If we can't figure out a way to enhance the basic economic or academic treatment, we don't release it. So we look at things like analyst revisions, a couple of different ways of looking at valuation, relative and intrinsic. We look at momentum. We combine those in a value momentum and combined alpha model, and we've built an earnings quality model that enhances the basic accruals anomaly as it's become known. We have some smart money models, so piggybacking on the activities of informed investors like corporate insiders, short sellers, institutional investors, which we look at with smart holdings. We have a number of other things like analytics. We'll be highlighting the smart estimates, predicted surprise, bold estimate, revision cluster. We have a number of different things here. We even look at countries of risk, where are their revenues, earnings coming from, where are they exposed. In economics, the smart economics I just mentioned, we also look at the risk of default at a country level, sovereign risk. And we even have a new sentiment model that we built in collaboration with our first external partner, MarketSight. We have very good global coverage. So over 40,000 companies in most cases. And the way we build our models is we create relative ranks. So in this case, we're looking at relative valuation rather than just look at one ratio like practitioners like PE ratios, academics seem to like price to book. We look at 6 different ratios. We look at both forward and backward looking ratios. So taking advantage of the SmartEstimate for forward ratios, reported actuals for trailing ratios. And you can see here in a little thumbnail, what's driving this score. So dividend yield is really high. PE ratio, looks a bit expensive. We rate it 1 to 100, where 100 is the best, the most bullish score, the top 1% of all companies here in North America. 1 would be the most expensive 1% in North America. So regional relative rank is our default. We also have a country relative rank, a sector relative rank, and an industry relative rank. So think of green is good, red is bad. Regardless of our models, 100 is the best, 1 is the worst. So these are readily available, on any company landing page within Workspace, and it's also available via data feeds. We use the SmartEstimate in a lot of our work, not only in our relative valuation model for forward-looking valuation ratios, but in probably our most popular model, our analyst revisions model, because there's a lot of work that you would have to do to build a model like this. So most revisions models just look at changes in the consensus for EPS over the last 30 days for the current quarter or the current fiscal year, if companies don't report quarterly. We take a more holistic or broader view of this, looking not only at revisions in EPS, but also EBITDA and revenue. So we look across the income statement and over multiple fiscal periods. So here you can see this quarter, the full year, and next year's estimates. So you can see how it's changed throughout history. The gold, again, is the SmartEstimate. It's higher across the board, across the income statement, throughout each of these fiscal periods. So leading to this high score of 95. You can see the history in the top right. Back summer of last year, it was low. Recently, analysts have become much more bullish, raising their estimates for this company. We also look at the change in recommendations. We find that buy, sell, hold estimates or ratings are not terribly predictive of future price performance, but there's a lot of information in the change in recommendations, whether an analyst is moving from hold to buy or from buy to strong buy. That's highly predictive of the change in future estimates and stock price movements. So estimates are highly correlated with price changes. So where else can you find our SmartEstimate predicted surprise? In our various Refinitiv Workspace applications. So this is how you can embed them into your own research and investment workflow. So the predicted surprise is also informative, in aggregate. So here I'm looking at industry groups, these are GICS industries. We also have our own industry classifications, TRBCs. So looking at where we've seen the highest predicted surprise, aggregating across all these industries, I'm doing this globally. So this includes developed Asia, ex-Japan, developed Europe, and North America. Large and mid-cap stocks, you can see that results in 5,000 plus securities. We're seeing the most positive predicted surprises here in software, 216 companies. So a large deviation above consensus. Life sciences, tools and services, conglomerates. You read through the list. The right panel shows the biggest negative deviations from consensus. So analysts very recently downgrading their estimates well below the consensus expectations in diversified customer services, road and rail, higher gasoline prices, anyone? Hotels, restaurants, and leisure probably see inflation, and again, energy, equipment, and services at work. Entertainment, IT services, inflation bites into a lot of discretionary spending, it seems, causing analysts to have lower expectations for earnings this quarter and year, and food staples and retailing. So these are full year 2022 expectations. The analyst revisions model that I touched on, saying it's our most popular, it still performs really well, can be used in aggregate as well. So where are we seeing the highest revisions? Oil, gas, and consumable fuels. Yeah, that price at the pump you're paying is resulting in higher profit expectations for these companies. Marine, shipping costs. Metals and mining, commodity prices are rising. Software, again, we see life sciences and services, semiconductor and semi-cap equipment, air freight and logics, auto, banks. Where are higher energy prices hurting companies? Airlines, gas utilities. We're also seeing higher commodity prices, maybe not for paper and forest products, however. A decline in hotels, restaurants and leisure, internet sales. Tough comps compared to last year, biotech, entertainment, building products, and food. Look at the nice correlation between the revisions in analysts' expectations and the 52-week total return. So in the left panel, where you see a lot of green, analysts raising estimates, you also see prices generally going up, sometimes by a lot. Marine, 118% in aggregate. On the right, you see a lot of red for 52-week returns next to the analyst revisions. So, you see things like paper and forest products down 55% over the last year. Hotels, 36%. Internet and direct marketing, 60% decline. So a good correlation between what analysts are doing and what the market reacts to. Another great application you can use to track earnings season for yourself as it unfolds is our earnings season app. Type EARN into your Workspace search bar. And we see here all 11 GIC sectors. You can see here I'm looking across these same global regions that 53% overall have beat the consensus, 4% met, and 43% missed. You can see within that, the financial sector has had the greatest number of upside surprises, 66%. Banks have been doing well. Energy is in number 2. At the bottom, materials and healthcare have come up short, more often than beat. You could also look at the current year surprise. For companies that reported, we show the actual surprise. For companies who've yet to report, we again turn to the predicted surprise driven by the Starmine SmartEstimate. We show the current year-over-year growth. We blend both those that have reported and have yet to report into blended growth. We look at next year's revisions. Perhaps this is a proxy from the sell side that reflects company guidance. And then we show the price reaction for companies that beat, those that have met, and those that have missed. Usually expect price reaction to follow whether it's an upside or downside surprise, but you can see that's not always the case. There are whisper numbers, some expectations are already baked in. And then we show the price change for companies that have yet to report. You can also customize the earnings season app. So you can put in any other aggregate data you might have an interest in. So I like the analyst revisions model. Type ARM or analyst revisions. You see it pops up in the little drop down. Click on that. And voila, you can build your own column that includes, in addition to all of these items that we include in the earnings season app, now you see a column for analyst revisions model, regional rank. You can compare it to all these other analytics and metrics. We're not just limited to a business classification view. You can also look at your own customizable list of lists and indices. So here I looked at a number of different indices globally. So we get things like the FTSE 100 for the UK. We have the S&P 500 for the US. We have Stockholm. We have Australia. We have Singapore, Switzerland. So here you can see that in the CAC 40, 79% of all companies and 83% have now reported beat consensus estimates. I don't know what's going on with Switzerland, but poor Switzerland, 85% of companies who reported 76% of those came up short of the consensus forecast. So I'll turn it over to Tajinder, and he'll tell you how to build your own forecast so you're not limited to just the major regions and indices that we publish on, but any investable universe that fits into your own research style. So take it away.
Thank you, Tim, for that great overview on StarMine and the various quantitative models and analytics that are available within Workspace. So as Tim mentioned, I'll spend a few minutes going through how customers like yourself can use this data in Workspace. So there's a number of areas within Workspace, whether it's through the desktop or the Excel add-in. All of this data is integrated within these multiple environments. We'll focus on the desktop application for today's webinar. And particularly, we'll look at the Screener app, which allows customers to screen for investment ideas, better manage risk. And in this example, we've taken a screenshot from Workspace, and we're particularly here in this example looking for positive surprise candidates in Europe. So we can see to the left screenshot, we have a filter for country of exchange. We can pick individual countries, or we can pick a regional classification that will automatically pull in the appropriate countries for you. We'll choose a market cap filter as well to screen out for companies in excess of $500 million typically. So this now below, we'll see the StarMine data that you can screen off of in the application. So things like the number of analysts. We want to screen for companies that have at least 5 analysts covering the company. Below that, we will then screen for the earnings per share predicted surprise, which is what Tim's highlighted earlier. Now we want to screen for companies that have a positive surprise greater than 2%. So as Tim mentioned, the 2% threshold is where the SmartEstimate is most impactful, and it will predict the direction of the surprise 70% of the time. So we want to include that filter as well. And then you can also add any other filters of your choice. So you can perhaps screen for companies that are going to report earnings in the next week or the next 2 weeks so you can better manage your workflow. And in this case, we also included a filter to screen for companies that have a high analyst revisions model score, greater than 50. Now, of course, you can customize your screen to your own preference, and you don't necessarily have to screen by country of exchange. You can load any of your own preferences, whether you want to load an index like the Russell 1000 or the Russell 2000. You can load any Lipper mutual fund. You can load your own watch lists or own portfolios as universes to screen off as well. So there's multiple options to create your forecast. So once you have the results, you can see we have about 120 results at the bottom right of that screenshot. What we then do is apply a light human overlay. So to perhaps look at better candidates that are more likely to beat or miss earnings using certain situations, which we'll cover in the next few slides. And as Tim mentioned, we create these forecasts for North America, Europe, Asia, Pacific, and we also will do other regions, including Latin America, Japan, Australia as well. So this is a great way for customers to go ahead and create their own forecast. So now we'll go into step 2, where we apply a light human overlay and go into those questions in a bit more detail to make you better able to look for more suitable or more impactful candidates that will beat or miss expectations. So the first example of what increases or decreases our confidence in the SmartEstimate and predicted surprise. So this example is showing when there is broad disagreement amongst analysts, especially when we're, in this example, we can see the analysts where the top two there are both 5-star analysts. So as Tim mentioned, the Starmine earnings accuracy rating is a 1 to 5 normal distribution, and only 10% of analysts can be a 5-star analyst. So it's a very prestigious ranking to have. These are the analysts you want to pay attention to. We see the second analyst has an estimate of 95 cents. It's highlighted in green, which is a bold estimate. As Tim mentioned earlier, it's a 5-star analyst that has made a bold estimate. We can see to the right the column where it says percentage difference from mean, which is the analyst's estimate compared to the consensus estimate, which in this case is 55 cents, pardon me, which leads to a 71% estimate above consensus. Now, if we look at the estimate above that, which is another 5-star analyst, his estimate or her estimate is 51 cents per share. Now, what's important here to note is if we look to the right, their estimate is actually 7.5% below consensus. So there's disagreement amongst two 5-star analysts here. And this would decrease our confidence in perhaps, or perhaps something to be aware of when using this data. So this is just tips and tricks that we sort of use when creating our own forecast. And this sort of highlights that when you see analyst estimates sort of all over the place. And within Workspace APM, you can actually sort these columns. So for example, if you can sort the percent difference for mean column, and then you can see the distribution more easily of analysts. You can sort of see how many are above consensus, how many are below. So typically, if you see a lot of analysts that are above consensus, and that will be a more encouraging sign that company would be likely to beat analyst expectations when they report. So the next example here is what we call betting it all on one analyst. So in this screenshot, we can see for this company, there are 5 estimates covering this company. And as Tim mentioned, Starmine will apply filters or criteria such as removing stale estimates from the SmartEstimate. So any estimates that are greater than 120 days old will be excluded from the SmartEstimate, and that's because we want the SmartEstimate to have the most recent and timely estimates, which makes it more valuable for our customers. And we can see 4 of the 5 analysts to the very right. You can see where it says SmartEstimate weight. 4 of the 5 analysts have a X-age. So they're all removed from the SmartEstimate, leaving the sole estimate analyst having 100% weight in this example. So we can see the analyst with the 100% weight has an estimate of 1.14. And we can see down below the gold line, which is the SmartEstimate, is simply just reflecting that analyst's estimate, nothing more. And we can compare it then to the mean estimate of 112. So again, we would prefer to see more analysts included in the SmartEstimate, which makes it more impactful, as the weights of the analysts will be measured by their earnings accuracy. So the next example is when we see too few analysts on the same basis. So in this example, there are 5 analysts covering the company. We can see at the very top part of the screenshot, we have 3 analysts. It's saying included in the mean. And we see below that, there are 2 analysts who are excluded from the mean because their estimates are not on the same basis. And so we want to see, ideally, more analysts included in the overall SmartEstimate that also have the estimates on the same basis. Again, more input data will make the analytics more meaningful and more valuable. And finally, we want to see examples where the SmartEstimate and mean estimate, the difference between the two, have a large dollar difference. So generally speaking, when you have estimates that are in dollars, say a very high number, you will see a greater, or you will need to see a greater difference between the SmartEstimate and the mean to see a large predicted surprise. But when you are dealing in this case, in this example, we see this Hong Kong company, the dollar difference between the SmartEstimate and mean estimate is 0.3 of 1 Hong Kong dollar. And that's really a rounding error, you could say. But because we're dealing with small numbers, when you're dividing very small numbers by each other, that can lead to very high percentages. So in this case, we're dividing 0.114 divided by 0.111. It's leading to a predicted surprise of 2%. Again, this looks encouraging, but in this case, it's simply more due to a math issue here rather than a actual significant difference between the SmartEstimate and mean estimate. So these are just some tips and tricks that will help you interrogate the examples when you're screening for companies and eventually when you look at them on an individual basis. Hopefully these tips and tricks will help you analyze the potency of what you're seeing through the SmartEstimate and predicted surprise. So we'll wrap up by going through the results from our team, which we publish. So we publish our North American forecast on a quarterly basis. We publish Europe and Asia on an annual basis. And we'll go through our results now. So in Asia, companies tend to report later versus Europe and the Americas. So we haven't had any that have reported as of yet, but we can still see the examples that we've chosen here. So a couple of semiconductors, iron and steel. So things that we highlighted earlier where we saw these industries have a very high analyst revisions model score. So perhaps validates what we're seeing here, that a lot of these companies are expected to beat earnings expectations. And it's important to note that when we make our forecasts, we're actually creating this forecast well in advance of when these companies actually report. So typically we will publish our forecast as early as 6 weeks, 4 to 6 weeks before the companies actually report. So we will take the data as is on the date of when we publish our report, and we will then stick to our neck or stick to our guns and see what happens and if the company will beat or miss expectations. And again, actually in Asia, sorry, I should clarify. So for the ones in our 5 to miss, 2 have actually reported, and they both missed expectations earnings when they've reported. So we compare the actual, which is to the far right, and we compare it to the mean estimate at the time of publication. So far we've picked 2 of the companies out of the 5 that have missed. And so we're 2 for 2 so far. Moving to Europe. So all of the companies have reported, so we can see that in the expected report date column. And we were successful in getting 4 of our 5 predictions correct. Glencore was just off by a penny, unfortunately, so that's a nail biter there. But we can see, for example, NG, they reported earnings of 131 versus 119, which is the mean estimate. And again, for Pirelli, again, 44 cents versus 40 cents. So, and we can also see this for our misses as well. So 3 have reported out of the 5, and we've predicted 1 of them correctly. So again, some close ones here. Weir Group, just off by about 70 pence. So we'll wait to see how the final 2 come out. And we'll wrap up with our Russell 1000 forecast. So we use the Russell 1000 as our universe to make our predictions. And again, we will publish this forecast in particular on a quarterly basis. So this one will be produced 4 times a year. And we have, so most of the companies in the US have reported this for this earnings season quarter. And we've predicted 4 out of the 5 correctly in our beat forecast. So sectors like Freeport with strong copper prices, Exxon, of course, with the high oil and gas prices, and so we've gotten 4 out of 5 there, and then we'll wrap up with our misses, and we again scored 4 for 5 here, so for a total of 8 out of 10 in Q4. So that would be an 80% accuracy rating. And again, as Pete mentioned at the top of the presentation, if you wish to learn more about what our team does as far as our earnings reports or our ad hoc research posts that we publish, you can visit lipralpha.refinitiv.com, or you can simply type in alpha in Workspace and it will launch the page you see here. And we have some information at the bottom if you want to learn more about Workspace for APM, if you want training and support as well. So with that, I will hand it back over to Peter.
Thanks, TJ, for the presentation. And thanks, Tim. Just looking at the chat, or looking at the questions, we'll just go through a couple of these here. I've got questions that are a bit similar, so maybe I'll group them together a bit. Questions around the smart estimates. So perhaps for yourself, TJ, a question around why did you choose 5 analysts for your screener? What is it about that number of analysts? Is there a minimum number of analysts that these smart estimates need to be meaningful? A couple of questions, but I sort of bucketed them together. TJ, I think you're on mute.
Oh, sorry about that. Yeah, so we recommend having a minimum number of analysts when screening for candidates. And that's simply because you'll find that if we don't have that filter in, you will get many results showing up in your list where perhaps only 1 or 2 analysts are covering that company. And again, we mentioned it won't be necessarily meaningful if there are only a handful of analysts covering that company, because it'll be very likely that maybe only 1 single analyst will make up that smart estimate. So we won't see much deviation from the consensus. So we recommend at least 5 analysts at a minimum. And in the U.S., for example, for some of the large cap companies like Apple and Amazon, we will see up to 35, 40 analysts covering a company. Of course, we won't see that everywhere, but again, the higher number of analysts we find, you'll find it's more reliable when looking at the smart estimate and predicted surprise. It'll be less sensitive to outliers as well.
Gotcha. Makes sense. And maybe just another question on a similar line that I'll group together with this, and then we'll go on to a slightly different topic in the questions here, is what do you mean by analysts being on the same basis? Just to clarify, when you were speaking about the analysts that weren't on the same basis.
Yes.
So I can probably. Oh, go ahead.
Oh, sure, Tim, you can go for it. Yeah, no problem.
Oh, I was going to say that refers to an accounting basis. So the IBIS methodology is one of majority rules. So if the majority of analyst estimates are based on something like GAAP accounting, that will be the consensus. Analysts who are making their forecasts on a non-GAAP basis will be in the, still displayed, but not included in the estimate. Usually it's the opposite. A lot of companies, especially in the US, now report on a pro forma or non-GAAP basis. They'll exclude things like stock option expenses, things like that. So that shows up in consensus. But in the example that TJ showed, there's basically an equal number of analysts on both ends. The same basis as a different basis. Do you have anything to add to that, TJ?
No, nothing more for me. But yeah, just some other examples of perhaps for the audience. We may see, for example, things like one-time items, charges, whether they're legal charges or gains or losses on disposals or segregation of different divisions. You can see that can also cause analysts to be on a different basis as well.
Awesome. Thanks both. So I've got a question here about performance, which I think is on everybody's mind as fund managers. I guess the question maybe I'll pose to Tim. Are you able to talk about the Starmine model factor performance? So those alpha models you mentioned in the beginning of the presentation, what has the performance been over the last 12 months? Have you seen any kind of major changes on those models or factors in terms of which ones have worked the best?
Oh yeah, thanks for that question. I actually author a monthly Starmine model performance report. You can subscribe to get that. It's free. Go to Lipper Alpha Insight and there's a subscribe tab. So yeah, I look at that all the time. And we've seen a big rotation until very recently out of like momentum and growth and into value stocks. So value as a factor hasn't worked for a number of years, until about middle of last year. Then suddenly valuation models swamped the performance of things like growth and value. It's only accelerated under, the anticipation of higher interest rates, which lowers the present value of earnings streams that are well out into the future. Saw a little difference last month. So valuation wasn't quite as strong. Momentum kind of came back. And I think the reason for that is that some of the leading stocks, both in terms of the higher ranks of valuation, they looked more inexpensive, that also had good momentum were things like banks and energy companies. But they've had such a good run of performance, I think they kind of outgrew the cheap category, but they still have good momentum. But yeah, so just about the time everybody was ready to throw out value as obsolete, it's come back to the fore as well as smaller cap stocks. Again, last month they outperformed.
Cool. Thanks, Tim. One more question here around performance that I'll just jump in with as well, because it's on a similar vein here, but it's a bit of a different question. A question around the long-term accuracy of your team's earnings predictions. So the reports that TJ was mentioning.
Instead of letting him blow his own trumpet, I'll do that for him. He's got a great winning streak going here. He's the primary author of our reports, along with my other team member, Thomas Alonso. So the long run average, which we keep track of, in North America since 2012, it's our longest track record, has been 76% accuracy. So that's about 10 percentage points above, the just right out of the box. So those tips that Tajinder, TJ, said is a light human overlay to the predicted surprise, greatly improves the odds. Surprisingly, you might think, oh, this gets arbitraged away, everybody knows about it. It's actually done better more recently than the long run average. So looking back to 2019, you'd think it'd been really, really tough to get estimates correct in the volatile markets where we go into lockdown and then we reopen and we're going to hike Fed rates. But we've actually been 82% accurate in our forecasts over the last 3 years. So you can see that instead of the opposite, the SmartEstimate predicted surprise is especially useful during volatile times. Separate the more accurate analyst from, the average.
Cool. Thanks, Tim. One last question here, maybe before we wrap up, just looking at the time at the top of the hour here, is maybe a little bit more around the content that you source from. So I've got a question here about how the analyst data is gathered. Are all of them collected through the released reports? Or does Refinitiv do a kind of periodic survey to sort of prod analysts for those estimates?
No, we make it available as we get it. All of our analyst ratings and the SmartEstimate is updated every day. Right? So it's very timely. And in fact, remember I talked about the analyst revisions model? We've improved the content from that, so we get it from a slightly different source, improving the coverage, and we're before long coming out with an intraday arm. So we'll probably update it roughly hourly. So if analysts publish new estimates during the trading session, our model will quickly react to that as well. So it looks like that's going to be even more responsive and even more powerful.
Awesome. I think that's a great spot to end it, Tim. Tim, TJ, thank you so much for your time walking through both our existing clients and guests to the webinar through the wonderful world that is the tools they have to try and hopefully beat and exceed the markets and beat their benchmarks. So thank you all for the time attending today. We'll share this as an on-demand recording with you in a post-webinar email out to the group. For more information, clients can, of course, reach out to their account managers to look at all of the great things that TJ showed of what you can do with our applications and platforms. And of course, anyone new joining this webinar who's not an existing customer, you can, of course, reach out to us through the Contact Us, which we'll share in the email communication, as well as, of course, going to refinitiv.com, which all roads will lead towards someone to get on the phone with you and talk to you about the tools and solutions that we have. So thank you so much for joining. Thank you, Tim, and thank you, TJ, and thank you, the audience, for your great questions. We'll see you next time.